back. Well, it is a time in the housing market that feels like everybody's waiting. Sellers are waiting for prices to come back up. Buyers are waiting for prices to fall further. According to the Canadian Real Estate Association, home sales fell 5.6% in June from May across Canada. Prices declined another 1.9%, but prices are still up 14.9% year over year. And the national numbers obscure some more dramatic moves in hotter urban centers. Toronto saw home sales drop in volume by 47% in July compared to a year before, although prices declined just 2% from the previous month. So what are the catalysts that we should watch for that might determine either a recovery in prices or even steeper declines? Nasma Ali is the founder of and a realtor with One Group, a division of RE/MAX Hallmark. Great to have you with us.
Thank you for having me.
So it really does feel a little bit like a standoff here, Nasma. What are you seeing in terms of both sides of this equation and what you think might tip one in one direction or the other? In other words, prices will suddenly come down steeply, or the buyers will say, okay, I really do have to get in at these levels.
I don't know about prices declining steeply. They've been pretty steady. It's not like we saw, a 50% decline in 1 month. As you said, I mean, things are selling, but they're not selling at the same rate as last year because, again, back to what you said, buyers are waiting and sellers are also waiting. I would say what we're seeing right now is just no movement or very little movement on both sides. Sellers are afraid to sell. And that goes for investors as well. Investors are now choosing to rent out their properties versus selling. And then buyers are choosing to wait. And people who are looking to buy and sell are also kind of, I would say, in a browsing phase, right? There's very little urgency right now to move, unlike what we were seeing during the pandemic.
And of course, for many, Nasma, they would not have seen rates rising. That's a kind of a relatively new thing for a lot of participants in the market. But certainly rates that are, at 4, 5, 6%, we may wind up at that for the overnight lending rate, which would send mortgage rates very high relative to what people are used to. Is there some education going on as people kind of rethink what is a good mortgage rate?
Oh, yeah. It's not just education, I would say. There's just a lot of fear going on from buyers and a lot of confusion. First off, in terms of what does it mean for me, not just for new buyers, but also for buyers who've purchased in the last 2 years and are very scared because what if they have a variable rate? Or what if they have a fixed rate and this continues to go on in 5 years? Mm-hmm. So I think there's a lot of fear going on. Maybe people are not necessarily talking about it or asking the right professionals, but there's definitely changes happening because of these rates, a lot of turbulence. And the problem that we have right now is that it's ongoing. There's no end to the rate hike that we can see so far. And there's probably going to be another one in September, which is just adding to the uncertainty, to the low urgency from every side. And I don't blame them, right? Because people, they want to know what they're going to be paying monthly. Mm-hmm. And if we don't know what the rate's going to be in September, why should anyone pull the trigger unless they have, a pretty good cushion?
There's, of course, also the side of the equation that you occupy, and that are the many people who facilitate these transactions, whether that's the realtors, there's people on the finance side, there's a whole bunch of kind of services related to this. Is this where you kind of separate, the good from the bad? Because we're hearing of a lot of transactions that are sort of stalling, financing's falling apart, or something goes wrong at closing. Is that where you know whether you've got kind of a good professional working with you or not?
Yeah, that's okay. This is, I think during the pandemic, we saw a number of agents increase to almost 70,000 agents in the GTA. That's a lot. And again, it's because, people are seeing it as this is free money, things are selling easily. Of course, this is what happens in this kind of a market. But now there's a lot more difficulty, as you said, and I think it's just going to weed out a lot of kind of the dead weight. But just to be fair, even good professionals in this market are facing issues, right? Because when things go bad, who's the first person that you blame? Usually you're going to blame the realtor, right? Even if the realtor has a great, track record, things go wrong. And to be honest, there's been a lot of lawsuits now, right? A lot of lawsuits floating around left and right because buyers are unhappy or sellers are unhappy or whatever it is, right? And it's causing, and I'm not sure if that's being covered enough, but that's one of the repercussions in this market for sure.
All right, we'll dig into that. Nasma, great to have you with us. Appreciate it.
Thank you so much.
Nasma Ali is the founder of and a realtor with One Group, a division of Remax Hallmark. Well, a hot housing market was driven partly by limited supply. Rising rates, of course, may choke off the desire to build new properties. According to real estate research firm Urbanation, at the start of this year, there were 35,000 new condos set to be pre-sold in the Greater Toronto area. In the first 6 months of the year, only 16,000 units launched. Another 10,000 are expected in the second half of the year. That leaves 10,000 units on the shelf at a time when new supply has been talked about as a much-needed way to cool the housing market. But developers who go out of business, of course, aren't likely to build many homes in the future. Is it a perfect storm for builders and developers? Kevin Lee is CEO of the Canadian Home Builders Association. Kevin, great to have you with us.
Thanks for having me.
So, I mean, obviously there's a cyclicality to all of these things. Where does this environment with rising rates, high costs, a tough labor market, this has all been something that's been going on for years now, where does that fit into how you see the cycle for home builders?
I think we're in a very unusual cycle, obviously, coming out of the pandemic. We're very much in an uncharted territories. As you rightly pointed out, we're still facing the shortages, not only of supply of housing in general, which is such a huge issue, but of course, labor shortages, material shortages. But there's no question that's what has had the big impact on the market in recent months has been those escalating interest rates that are really changing the playing field for would-be buyers and probably most especially first-time buyers who get knocked out of the market in these types of instances. So it's definitely a challenge.
We know that supply is a big piece of the equation. We need developers and builders to keep building new supply. There's already a sense that we're not going to hit kind of the targets we think we need. Should we expect to see people go to business? Is this the kind of a slowdown where rates go up and we see buyers on the sidelines and some of the builders or developers don't survive this period?
Well, anytime you have escalating interest rates in a slowing market, there is that risk. On a more positive side, the start of this year still saw industry sentiment very high. Housing starts through the sort of first 5 months of the year have been pretty good, so hopefully that will be enough to sustain the market and sustain industry players, but there's no question things are slowing down. We have a housing market index that measures industry sentiment, and it was extremely high still through Q4 and Q1 of this year, up around our number out of 100 was up at 89, and now for the single family it's dropped down to 66, and for multifamily it's dropped down to 60. So that's a significant drop, which is a precursor we expect to slower starts in the second half of the year.
And profitability obviously is a piece of the equation here, right? Not unlike a farmer, you need kind of the profit from the last build as the seed corn for the next crop. So when we factor that into the mix, do you expect profit to take a hit even if people do continue to build and developers stay in business, if they'll do so in a leaner fashion?
Well, there's no question that margins get cut in a market like this moving forward, and that was already starting to happen as we saw price escalation in the resale market, largely due to supply and demand. The same holds true on the new construction side, but the difference is on the new construction side, you had rising costs, as we've been talking about in terms of construction costs, and those continue to go up. Lumber has subsided a little bit, thank goodness, but pretty much every other construction material has continued on an upward trend. We're looking at close to $80,000 in increased costs on a 2,500 square foot house over the past couple of years. It was sort of split between lumber and other materials. Now lumber is coming down a little bit by about 10%, but other materials have gone up another 10% over the quarter. So yeah, lots of challenges on the margin side.
Not a ton of time, but what about the labor side? I mean, costs have been high. It's been a very tight market. I know that skilled labor has been hard to come by for a long time now. What does that picture look like?
Yeah, it's tough. We're still facing labor shortages. About 22% of the labor force is still set to retire over the coming decade. Great time to get a job in the trades if you're looking for one. And certainly we're seeing costs on those are up as well. They were up about 26% again since the start of the pandemic from our last survey. So still quite a challenge both on the cost side and the supply of labor side.
Great to have you with us, Kevin. Appreciate it.
Thanks for having me.
Kevin Lee is CEO of the Canadian Home Builders Association. Coming up, what are the long-term consequences of an overheated housing market? But first, this. In a sign of the times, like few other, this $27 million listing caught the attention of many, but none more so than fans of the cult classic film Mean Girls. Those fans may know it as home to Regina George, the arbiter of taste, or as the Mean Girls say, anything that's fetch. Given that the price jumped from $12.8 million to its current $27 million level in just 7 years, it strikes us as a particularly sizable sign of an overheated market. We're back after this.